Ever bought a gadget that promised to change your life, but the only thing it changed was your mood when it broke after a week? Like that fancy blender that struggled with ice. Which can help avoid those mishaps. Right now, get a digital annual subscription for half the price, just £39.50 for the whole year. That's less than 80p a week, cheaper than that daily coffee habit. Which offers expert, independent reviews on everything from kitchen appliances and cars to mattresses and TVs. Every product is purchased and rigorously tested in the lab to provide honest verdicts, so no more regrettable purchases. Enjoy access to the Which app, the Ask Which service for personalised buying advice, and the 11 digital editions of Which magazine throughout the year. Half price, expert advice, and no buyer's remorse. But hurry, this offer won't last long. Head to which.co.uk/podcast offer to get a digital annual subscription for just £39.50. Offer ends 12th of March.
New data suggests that around a quarter of Generation X, that's people aged between 45 and 60, are not on track to have enough money for retirement. And the same goes for only a slightly smaller proportion of millennials. So are you on track to have a big enough pension pot? And how much exactly should you even be aiming for? We'll be deep diving into the numbers and how to get you on the right track. I'm Lucia Ariano, and this is Which Money. Welcome to the show. Now, joining us to get into this and a lot more detail, we have Which Money pensions expert, Paul Davies. Hi, Paul.
Hi there.
And also Director of Public Policy at AJ Bell, Tom Selby.
Hello.
Hello. Thank you both for coming on the show today. Well, shall we start off then with the headline I mentioned at the top? So this figure comes from Annuity Ready and the Get Britain Pension Ready campaign. So 28% of Generation X, they say, are on target. What do you both make of it? Is it surprising?
I was surprised. If you look at the figures, it was 28% of Generation X, and the cohorts either side, millennials was 47, so many more feel that they're prepared. Baby boomers 37%, so much lower for Gen X. I say I was surprised in comparison to other groups. We did some similar research last year as part of our retirement tracker, mainly pre-retirees. So again, Gen X, people aged 45 to 60 roughly. And we asked people whether they felt they were saving enough for retirement. And about 39% said yes. So you've got 6 in 10 who are basically saying no, they're not confident that they're saving enough for retirement. And we also spoke to retirees, those already in retirement. And I think 4 in 10 were concerned about running out of money in retirement. So you've got two parts to it. You've got building up enough pension to fund your retirement and whether you're on track, but also you've got some concern once people retire whether the money is actually going to run out.
I'm not massively surprised, I've got to say. So when you look at that group, that Gen X as it's called, so for age 45 to 60, there'll be some people in there who've managed to prepare quite well for retirement. So they might have enjoyed a defined benefit pension in their younger years and now managed to top that up with a defined contribution pension through auto enrolment. But there'll actually be a decent chunk who will have missed out on the kind of glory years of defined benefit pensions and then have only just started to save in a defined contribution pension through the workplace. They might not even be in the workplace, of course. And so they're kind of caught betwixt and between two worlds. If you're younger and you're being auto-enrolled, you still need to think about saving more than that minimum, particularly if you've been auto-enrolled at the minimum. But actually, you've got time to build up your pot and for your money to grow and for you to increase your contributions as you go through. I think the other point is that it is just really uncertain. So there's that portion of people in that survey who are saying, by implication, are saying they think that they do know what they need in retirement. Actually, there'll be a decent chunk of those people who are completely wrong because it's one of the hardest things to know. I cannot tell you hand on heart how much money I'm going to need to fund my standard of living in retirement because the world will change. I don't know exactly what the state pension.
We're going to try.
Sorry, I'm not meaning to kind of do down everything we're talking about, but it is all really, really uncertain. And I think having kind of ideas of targets is useful, but it's just really, really difficult to know what your cost needs are going to be when you're older and therefore what you need to set aside now in order to achieve it.
And I think it's interesting we're talking about whether people are on track. I guess it's on track with their pension savings, but there's other bits of wealth that we need to take into account. If we're looking at the 45 to 60-year-olds, for example, they might have benefited in terms of property wealth. You know, they might have bought properties in the late 90s, early 2000s when property was cheap. So, you know, there's property wealth against pension income. And you've also got, you know, debts, that there'd be very little student debt amongst that group, for example, whereas you move down the generations, and that's a big factor. So here we're talking about on track in terms of pension income, but there's many, many bits to this, really.
Well, shall we try and put some figures to this then? But first, actually, can we just talk about, you know, what kind of makes up a pension pot? Because there are building blocks here, aren't there?
Yep. So if you're in the workplace, then your first port of call is your workplace pension. So as I mentioned earlier, you'll be automatically enrolled into that workplace pension. You'll get a total contribution, including yours, a bit from your employer, and tax relief of 8%. Now, that's slightly confusing because at the minimum, it's not 8% of all of your earnings. It's 8% of what they call band earnings, so between just over £6,000 and around £50,000. Those aren't exactly the numbers. So that's the minimum. Lots of employers offer more generous terms than that. So it's really important, if you're in your employer scheme, you speak to your HR department or whoever it is who handles the pension to make sure you're maxing out those matched employer contributions, because it's essentially free money, and if you don't take it, then you're kind of taking a voluntary pay cut by not accepting it, which most people don't want to do. If you're self-employed, it's a bit trickier because there is no employer, so it's up to you to take the initiative and set up a pension for yourself. But once you've done that, then the question is, how much do you need to pay in, and from what age, and you know, what are you aiming for? One of the most useful things I was told a long time ago, and it's not an exact science, any of this, but was that if you're starting to save in a pension, then you take the age that you're starting, you divide it by 2, and then that's the percentage you need to aim to put into your pension each year in order to achieve a decent standard of living in retirement. So if you start at 20, then you're aiming for around 10%. If you delay to 30, then you're aiming for around 15%. Now, it's not exact, but I've always found that quite useful. And it also shows the power of starting earlier. The earlier you can get saving, the earlier you can do those building blocks, the easier it will be to do it over the long term. Now, those numbers will still look quite scary to a lot of people, but any saving that you can do in a pension from those early days, making the most of free money and tax relief, is going to go a long way to making sure you at least have a decent standard of living in retirement.
Well, should we try and put a figure on it then, as far as we can? Paul, you're smiling at me. So I suppose, how can we put a figure on it? How do you work it out?
Yeah, I was just going to say, we were talking about workplace pensions there, and these days it's mainly, without getting too technical, so-called defined contribution pensions, whereby it's down to you to build up a pot with the help of your employer, and then you get a final pot that's invested, and you turn it into an income. There's lots of talk about the death of final salary schemes, but lots of people still do have. They're not usually final salary schemes, they're career average schemes, whereby you get a guaranteed income at the end of your working life. I think it's around 10 million active members, and it is mainly the public sector these days. So if you're a teacher or a doctor or a nurse or work for the police or in the fire service, you've got guaranteed income. So there's different types of workplace pensions still. There's fewer of the defined benefit schemes these days, but it's still worth remembering in certain professions you have a bit of a head start, really.
Mm. And then, of course, the state pension kind of tops up what you need to save in your private pensions.
Yeah, so you've split into 2 private pensions, as we say, workplace pensions of different varieties, and then the state pension, which is guaranteed income when you qualify for it. The caveat is, we're having to wait longer to qualify for the state pension. It's currently age 66. It's gone up from 65 for men, 60 for women in the recent past, and it's going up again. It's going up to 67 by 2028. And then up to 68 eventually. They haven't decided yet, but it's
we'll
going,
be in our 70s.
Well, it's going in one direction. You can say that, and it's only going to get higher. So let's see what happens in the future.
And that's one of the challenges for young people as well. So you talked about that survey at the start, and Gen Xers and Gen Zers say, for someone who's in their 20s or 30s to tell them confidently, this is how much state pension you're going to get, and this is when you're going to get it. I think it's actually really, really difficult to do. I think I always assume that there will be some sort of state underpin for anyone's retirement income to look after the poorest and to provide a basis. But we've already seen significant changes to the state pension, even over the course of my working life. And I couldn't hand on heart say to a 30-year-old that the state pension as it is today is going to be similar when they reach the point of drawing it in, as you say, probably 40 years' time.
Well, shall we bring some figures in then? So how much will the state pension, how much is it likely to be giving you when you retire, and how much more might you need from your private pot?
Well, we use figures which are produced by the Pension and Lifetime Saving Association. So in terms of annual income, they have 3 different levels of income, so a minimum level, a moderate level and a comfortable level. Their figures indicate that a couple needs roughly about £43,000 for the middle of those levels, and it's up to nearly £60,000 a year for a couple for the comfortable, so a few luxuries, a few more holidays, newer cars, those sort of elements. So you're talking some really big and scary numbers. So that's in terms of annual income. And then you take a step back and calculate, well, how much in terms of my overall pot do I need? And again, for that middle level, you're talking roughly £400,000, and that's just private pension before the state pension is factored in. So as a couple, you've got this huge figure to aim for, which is, it provides a bit of information in terms of whether you're on track or not, but it can be a bit dispiriting, I guess, in that you feel like you're not on track and you're always behind. So yeah, there's some big numbers in terms of securing a comfortable lifestyle in retirement.
How do you work out how much you might need over however many years from when you retire?
It's really difficult because when do you retire? Lots of people partially retire. Are you going to retire at 65? Are you going to retire at 70? What kind of health are you going to be in? Are you going to need social care? Are you going to need healthcare? Are you going to have extra healthcare costs as you get older? Will you still be paying a mortgage or rent when you're in retirement? That's going to be increasingly common for generations coming down the track. So it's very difficult to know exactly what your costs are going to be, and therefore to know exactly what you're going to need to save in your pension. But I think data like the PLSA data is useful in kind of setting at least a reasonable benchmark. I don't think nobody should treat this as kind of the be-all and end-all for saving for retirement, because actually anything you save in a pension, particularly in the workplace where you get that matched employer contribution, you get the benefit of tax relief and tax reinvestment growth, is all going to be a good investment. And then the question is, how do you build up as much as you possibly can in order to achieve those goals? Now, for younger people in particular, they'll have lots of competing options for their money. So you might be raising a young family, you might be trying to get on the housing ladder. So the pension might not be the only thing that you're thinking about. But I think the key thing is to get the message across to people that if you want a decent standard of living in retirement, you need to start saving as early as possible and factor it in to the budgeting that you're doing today, even if it feels like a stretch. Any kind of little bits of extra money that you can save regularly on a regular basis into your pension in your 20s, in your 30s, in your 40s will make a massive difference when you get to that point when you're slowing down and stopping working.
And I suppose by comparison then, the minimum that we might need when we retire, how far will the state pension take us in reaching that?
So I think for the couple, the minimum level is about £22,000 a year. It's about £14,000 a year for a single person household. So the state pension at the moment, the full level going into next year is about £235, I think, per week. So that's, what's that, £11,500, £12,000 a year. So potentially it forms quite a big chunk of the minimum level, but the minimum level, as you'd expect, is paying for the basics, and as I say, not much in the way of fantastic overseas holidays and new cars and leisure spending. So you're just covering, energy bills, food, sort of the basics. So again, I get what Tom's saying. These targets are big and scary and way off, and sort of if you can get halfway there or 2/3 of the way there, that's a good foundation. But you shouldn't depend just on the state pension. It's a pretty frugal lifestyle if you're just living off the state pension.
Yeah. Don't depend on just the state pension, and don't assume that your workplace pension contributions, particularly if you're being auto-enrolled at the minimum and you're someone who's, say, in their 40s, for example, are going to automatically take you to a comfortable standard of living in retirement, because they're just not going to achieve that. So if you want a retirement from age 66 and you want to have 30 healthy years where you get to go on holiday 3 times a year and essentially live the kind of lifestyle that you're living when you were working and earning, then the reality is you're going to need a huge pot of money to do that, and you need to start saving early in order to achieve that. And the big numbers can be scary, but it's just a mathematical reality, really. If you're talking about 30 years where you have no other income, then you're going to need a huge pot of money to sustain a lifestyle. Even if it's only £20,000 a year, you take that over 30 years, and you're going to need at least £600,000 plus to enjoy that quality of life.
And to point out the obvious, as you're saying, even from those figures, it's harder if you're a single person living alone than in a couple.
Yeah, when we looked at the data, obviously if you're a single person, you're not going to your expenditure is not going to be 50% of a couple, because there's some stuff that's going to be proportionately higher, such as home insurance, energy bills. So we in some of our analysis we say that a single person will spend about 75% of a couple. So you're at a disadvantage from the start in that stuff costs more generally. And also, a couple past state pension age will get 2 times the state pension and 2 times the tax-free allowance. So, again, in all of our number crunching, it seems a bit unfair on single people once they pass state pension age, in that they got these disadvantages. But going back to something Tom said, there's so many variables. I guess I hate to be Mr. Gloomy, but the part of this you don't know is how long your retirement's going to be. That's what makes this all so difficult, because you can say, well, average retirement is 20-25 years, but it may not be. It might be longer, which is obviously a good thing. But in terms of your finances, you're going to have to make them stretch further. And the other element here is how long you're going to work. I think the average age people stop working at 64, which is great if you're capable of working that long. But I saw some stats a couple of months ago in that healthy life expectancy is coming down. So life expectancy's gone up over many years, and it's all plateaued a bit, so people are living longer. But how long they're healthy for is actually falling a little bit. So we're assuming, let's all work to 64. We can work in some professions, that's entirely possible. If you've done a very challenging job, a tough manual job all of your life, you might not be in a state to work past 60. So it's great crunching the numbers. It's great having these aspirations, but the reality might be somewhat different for some people.
Yeah, and I think to that point, I think the reality for lots of people is if they physically are able to, then they might need to work a bit longer than previous generations have done. So whether it's taking part-time work just to supplement your pension income, so into your 70s, for example, if you're physically able to do it, then that actually, it can be a really sensible, and if it's the right job, it can be quite a fulfilling way to move into retirement. So rather than retirement as it historically has been in a world where final salary pensions were aplenty, people worked for one company, maybe 2 companies, stopped at 65, got the state pension and got a big juicy final salary pension, didn't have to worry about anything. In a world where you've got this pot of money that you have to turn into an income and there's uncertainty, if you are able, let's say, to supplement your pension income with some private income, even if it's just a couple of days a week, then that could make all the difference. If your pot is a bit below some of the numbers we've talked about here for the PLSA standards, it might be able to get you up to that standard.
And I know we've talked about how difficult it is to put numbers on this, and you mentioned your way of calculating by taking a percentage of your age, 50%. Is there a number that we can give, like how many hundreds we might want to save per month at a particular age? Are there any kind of figures we can give kind of for our listeners?
Taking the moderate level of for a single person, which is about £31,000 in terms of expenditure. So if you start from scratch at the age of 30, and then we're saying that you get the state pension at 68. So we're assuming you work to 68 until you get the state pension. So it's just over £600 per month going to your pension, which again sounds scary, but you need to factor in that you get pension tax relief from the government. So that's a top up from the government to the tune of 20% if you're a basic rate taxpayer, up to 45% if you earn more than that. And as most people in workplace pensions, you will get that employer contribution. So it's £600 between you, the government, and your employer. So that's at age 30. So if you wait till you're 40, that goes up to £900 per month. So we are talking even bigger figures here, and something that's slightly daunting. So, again, Tom mentioned auto-enrolment earlier. The good thing is that it's, you are auto-enrolled, you'll be put into a pension, and, you should stay in that pension if you can and make contributions as and when you can. So roughly £600 at age 30, £900 at age 40, but that's to get the middle of the three lifestyles that we've talked about. If we're talking about comfortable, which all the bells and whistles and holidays in the Caribbean and new car every year, at age 30 we're talking about nearly £1,000, and age 40 we're talking about £1,400. So yeah, big numbers.
People like me will come on shows like this and say, absolutely saving a pension, save as much as you can afford. But for lots of people, that's just not the priority. So, I would always say absolutely stay in your automatic enrolment workplace pension scheme if you possibly can. But beyond that, if you've got a young family and you're trying to save for a first home, then that absolutely naturally is lots of people's priority. So the key thing is to make it, as long as you make a conscious decision that actually I'm going to prioritise those things today, and I understand that it means I'm going to have to work a bit harder to build up a retirement pot when I'm in my 40s or whenever it might be, then that's absolutely fine.
And yeah, having those conversations is important. There's not, other than myself and Tom, there's not many people interested in pensions. And it's not your dinner table fare, a dinner party fare. Funny enough, and it amazes me. Friends of ours will come around and I talk to them, and very intelligent people, but just switch off from pensions. It's not something they want to talk about.
I mean, it's not coming up on my TikTok algorithm. Maybe that's my algorithm, but I don't think people are talking about it either.
Yeah. Are we going to make it worse today or better? Hopefully, hopefully put it out. But again, people, I know someone who's a teacher, and she said to me, "Right, what about pensions? What do I do?" And it was, well, I think you're okay. I think you're fairly well covered, but it's almost wrapped up in your employment, and it's not separated in terms of something you need to focus on, which I don't know, is that good or bad? Again, maybe it's just a way of life, and you've got so much going on, and it's hard to review all the time. But just having those conversations, again, you may not be on track for these big numbers, but just knowing that at some stage you're going to have this pot and you're going to have to decide what to do with it, and it's going to have to last a certain amount of time, it's just worth considering.
Well, I think we're making it much more fun, as fun as it could be. We'll after a quick break.
You haven't been to one of my dinner parties.
Why not? Why ever not? We'll after a quick break. We'll be back with advice on how you can work out if you're on track, as well as plenty more advice, including how to track down all of your current pensions after this. Welcome back to the show. Well, can we talk about then, for any of our listeners wondering whether they might be on the right track, where would you start? What's your advice here?
I'll start at the basics, really. Actually knowing what you've got in your pensions. So if you've got a workplace pension, you're more than likely can have an online account, online portal. So have a play around in there. In terms of, obviously, what your current balance is will stick out, but have a look where your money's invested. There's certain bits of admin you need to do, including a nomination of beneficiary, so where your pension will go should you pass away. And a huge amount of people don't actually just fill out that simple form, and it will make life so much easier. So I'd almost. I'm going to be so boring. This is how I spend my Sunday afternoons. But
you're selling yourself short.
I
know.
But But, just spend an hour, a quarter, say, just, log onto your pension accounts. If it's still paperwork, make sure it's in one place. If you moved house, make sure your pension provider's got your new address. Just a pension MOT every quarter. And it won't necessarily improve your financial position, but it will put all of those things into your mind. And you might think, well, what is my contribution at the moment? Can I up that a little bit? So just a little refresher. That's one thing I think we can all do if we can force ourselves to do that.
Yeah, I think that's really good advice as well, because I think lots of people over the course of their lives, as I know you guys have talked about on the podcast before, will build up lots of different pension pots with lots of different people. So I know I've had conversations with relatives who've built up really old policies from back in the 80s and are completely confused with what they have, what they don't have, and what it all means for them. So if you can locate all those different pension pots, AJ Bell's got a service which lets you do that for free called a Pension Finder service. Lots of other services like that are available that can help you locate all your old pension pots. Of course, there are pension dashboard reforms coming, which should
Are they
allow
coming?
you.
They've been coming since this podcast started. I think about 7 years ago.
At some point in the future, near or distant, pensions dashboards will be a part of our lives, and that will make that whole process easier. But if you start by trying to find all your pensions, if you want to combine them with a single provider, so you've got them all in one place, and then there are kind of calculators and tools out there that can help you kind of mock up what you might achieve over the course of your retirement if you save X amount and your investment returns are Y%. So you can, as Paul said, you can have a play around with those things to see if you are on track and if you need to just boost your contributions a little bit to get there.
And one thing I just wanted to mention before we start wrapping up is, I know we've talked about boosting your pot and how much you should be adding. I mean, is there any kind of rule on whether you should boost your pot? When is it worth it? So given you might want to put money into your mortgage or any other types of savings or investments, is there some kind of advice you can give here?
Again, this is coming from a pensions analyst, but it's usually always sensible to put money into your pensions, because you do get that government top up that I mentioned earlier in the terms of pension tax relief. So 20% or 40% on top of what you put in. And as long as your your workplace pension or a private pension is being managed effectively, that your investment returns should be positive. So that pot will grow. And again, with growth over a number of years, that should push you in the right direction. So yeah, let's be realistic. If you've got a huge mortgage and you're having to service that, or one-off requirements pop up, my son started university in September, and that's a big sudden hit to my finances that I hadn't quite factored into it all. So you're going to get ups and downs and stuff, but generally put money into your pension if you can, and if you can avoid cutting contributions, do so, because sort of once you do, it's hard to go back up to the level they might have been. So again, sit down and have a hard think about, can you cut other stuff, but not always possible. But we haven't talked about bonuses, inheritances, that you might get a sudden influx of money, and again there'd be loads of demands for that money. But if you can put a little bit into your pension, it'll prove worthwhile.
Yeah, no rule as such, and Paul's even more of a pension nerd than me, because I don't check my pension once a quarter. It's probably more like once every 6 months, maybe once a year.
You're putting me to shame.
If I'm completely honest. But what we talked about earlier around reviewing how much you're putting in at key moments in your life, I think is a good kind of habit to get in. So if you review your pension, say once a year, to be realistic for most people, and then you think, actually my costs have gone down a bit this year, or I've had a pay bump over and above inflation, then perhaps you can scale up your pension contributions at the time that pay bump came in, and then that way your pay packet comes in and actually you've got a bit more than you had before, but more's going into your pension. I think behaviourally for a lot of people that can be that kind of auto-escalation of your pension contributions can be a useful way of doing it. So as your finances hopefully get better over your life, then just thinking about scaling up contributions when that opportunity comes can be a way to kind of ease some of the pain of having to put more of your money to one side till age 55.
So sensible, but I hear you. It's excellent advice, but it's so sensible. So final advice then. We've actually covered so much ground, but I did have a lot of questions I was going to ask you that we've had to skip over because we've covered so much ground, so I have to get you back on. But any final advice for our listeners, I mean, from any of the directions we've gone in today?
Again, repeating myself slightly, start early if you can. Try not to cut your contributions if there are any pressures. But if there are, be kind to yourself. It's going to be ups and downs. But if you've got that idea in your head that you're saving towards your retirement, that's a good start.
Yeah, don't be terrified of any of this stuff. So yes, when you're talking about having a pot of money that's going to give you an income for 20, 30 years, it's just going to be a big number. But you're saving from your 20s, your 30s, you're saving over a long period of time as well. So you can break those contributions down into more manageable chunks. And as Paul said, every pound that you're saving in a pension is hopefully benefiting from an employer contribution at a certain extent. It's benefiting from tax relief, and you're getting those tax incentives coming through. So even if you don't think you're going to hit the comfortable retirement mark, you might be close to moderate or somewhere between basic and moderate, that's absolutely fine. Just keep chipping away at it, and it's all a good long-term financial decision that you're making. So don't be put off by big scary numbers.
Well, thank you both so much. It's been a really brilliant episode and very, very interesting, Paul. So please don't sell yourself short. Thank you both so much for coming on the show today.
Cheers. Thank you.
Bye-bye.
Well, a huge thank you to Paul and Tom for coming on the show today, and to you for listening to this week's episode of the Which Money podcast. If you enjoyed today's show, please do hit subscribe to make sure you catch our new episodes as soon as they drop. For daily money news and advice, you can find us on social media at Which Money and online at which.co.uk/money. And we also have a free money newsletter, which is delivered to your inbox every Monday. To sign up, visit which.co.uk/money newsletter. This episode of the Which Money podcast was presented by me, Lucia Ariano, produced by James Rowe, and edited by John Weeks.
Every year, Which tests thousands of the products that you rely on every day. And we've been doing it for over 60 years.
Which reviews are 100% impartial. We don't accept freebies from manufacturers, and we have no owners, shareholders, or government departments to answer to. So our work is on behalf of you, the consumer.
In a world of misleading claims and fake reviews, we test everything, from everyday items to big purchases, so that you don't have to.
We then put them through tests and assessments that go beyond the accepted standard to work out how well these products work for you and what's not worth your money. And a Which membership not only gets you access to our reviews, it also funds our non-profit campaigning work, like getting scam ads banned on social media and ending broadband and mobile mid-contract price hikes.
And right now, podcast listeners can become a Which member for 50% off the usual price by heading to which.co.uk/podcast offer.